So after fantastic presentations and all sorts of positivity, I get to come in and be all negative on all the things that can go wrong. So as Ralph mentioned, I've worked in a number of different fintechs. I've had responsibility for identity and access, cybersecurity, fraud prevention, KYC, AML, and insurance. So I've got a pretty broad base and quite a bit of experience in what can go wrong in these situations. So today I'm going to walk you through the nature of the problem for fintech, which is honestly pretty obvious. It's in the fin. A quick intro to the financial system overall and your place in it as a new founder, and then just a quick overview of threats and early stage mitigation. So we're going to be looking cybersecurity and fraud, basically. Then we can open it up to questions. Obvious caveat, this is a 10, maybe 15-minute intro into a massive area of study. I will provide my contact info at the end if you want to reach out and you have particular questions or you want to get in the weeds on something. So the problem is finance, right? You're moving huge sums of money as a new founder who is just trying to figure things out, and you are going to be faced with a whole bunch of highly organized attackers who want to take your money and put you out of business. This is a serious problem. Criminals rob banks because that's where the money is. So there's often a perception amongst the inexperienced that financial fraud, cybersecurity breaches, things like that are quite rare. And the reason you have that perception is because companies go to great lengths not to have that information show up in the media. These things happen way more frequently than you think. And I would go so far as to say, if you manage to build a successful fintech of any size, you are going to suffer losses. It's just, this is a cost of doing business. Obviously, you need to work to prevent it, but there is no such thing as a perfect solution. You're going to have losses. When you're talking to investors about this, it's important that you have a little bit of a real world view of it. If you want to maintain credibility with the investors, because, and I read data rooms, I get pitches all the time. And whenever I hear somebody say something like, oh, we're not going to have any losses, like, no, you're missing things. The other one thing I would say on this is that technical founders tend to focus on cybersecurity, the hacking prevention, which is really important. Obviously, that's the torpedo that can sink your business. But fraud losses and other types of business risk are actually more the recurring day-to-day losses. So you really need to address all of the problem if you're going to protect yourself. So the global financial system it's a massively interconnected web of services. Now, the thing you need to understand is that when you become part of that web, you begin to represent a potential on-ramp for risk for everyone you connect to. So if you're connecting your service and you're moving money in payments, or you're allowing people to create accounts, or you're allowing people to, to talk about other products on social media, you represent a risk. And when you represent a risk, the rest of the financial system is going to try and mitigate that risk. And you also need to understand the risk that the rest of the financial system poses to you. For example, if you're offboarding your account, your KYC for account creation, who are you offboarding it to? Are they going to do the job properly? That kind of thing, you need to understand it. So one of your first goals in fintech is going to be to convince the rest of the ecosystem that you're a trustworthy and credible partner, because information sharing is actually really, really good in this area. It's one of the only areas in business that I've seen that is this collaborative. There's very much an us against them feeling. So it's us against the bad guys. And if you run into a problem, it is not unheard of, not even uncommon, to be able to call up another fintech and a major player, a financial institution, ask questions like, hey, we're seeing some weird activity in these accounts. We don't know what it is. Have you seen that? They very likely may come back with some helpful advice and information. On top of that, there's all sorts of information sharing calls that happen regularly. There's weekly calls with all the major FIs, the fraud departments, the major payments players, all that stuff. If you can get invited to those calls, you can get incredible access to information, and you can get early warning of what's going on in the ecosystem. that can be just incredibly valuable. The counterpoint of that is you must do whatever you can to avoid the ecosystem determining that you're not a credible partner and you represent a risk, because they will not hesitate to cut you off so fast your head will spin. A good example of this is a lot of the crypto exchanges early on in Canada did a really sloppy job with their KYC. They allowed a lot of fraud. Basically, they became an off-ramp for cash, where people would compromise accounts somewhere else, move it into a crypto account, and then pull the money out. And then what you saw is the banks and the major players cutting them off almost completely, and it really, really harmed their business and honestly slowed down the entire sector. So there's this media-driven perception of your financial criminal sort of as the lone wolf hacker living in their mom's basement, grinding away. Those do exist. That is a archetype, but the one you need to be really concerned about is more the organized crime model. So these are groups that are incredibly smart, organized, and very, very patient. So one of the things they will do is early on, and I loved Blossom's talk because you actually addressed this, which so kudos. But they will set up accounts on early stage fintechs with no ability to monetize them. They just set up a bunch of accounts and they leave them sitting there for future use as you add new features and functionality. And I've seen this pop up. This has been responsible for significant losses where dormant accounts have lived for years, and the fintech just let them sit there and they're not doing anything. Why worry about them? Until one day they opened up a new feature that allowed them to suddenly start hitting for money, and we're talking about 7-figure losses in a very short period of time. And as I said previously, attackers will use the interconnectedness of the system to exploit system level weaknesses. So if they can onboard through one account, maybe use that account as a credential to open a new account on a different fintech, move some money there to a third account that they can then pull the money out. So you don't just have to protect your own door, you have to think about how you fit in a bigger picture and how you might be used against the system as a whole. So quick talk about cyber attacks specifically. One note, this is bitter experience. They spike with alarming predictability as soon as you start to get media attention. Okay, so every time you're going to get mentioned in the news, on a major blog, anything, you can almost count that, yeah, you're going to get, somebody's going to come take a look at you in the next couple of days. So just something to be aware of. Make sure your team is aware of media mentions and attention you might be getting as things progress. Early stage stuff like the day zero stuff, do the basics properly: backups, dedicated machines, two-factor authentication on all your personal and business accounts, please. Don't ever roll your own cybersecurity defenses unless that's what your company does professionally. Go out and buy professional solutions. And if you have a breach, you're going to want to bring in professionals to assist, and try and start building those relationships before you need them, because when things go wrong, the last thing you want to do is be sitting there trying to figure it out and trying to learn your way around it. And then a last little point here: look at getting insurance before you have significant risk. First of all, insurance of this type is probably going to be required before you start doing any interactions with any major players. They're going to want to know that you have liability coverage and all that stuff. But on top of it, insurance kind of just, it gives you a sense of how risky your business looks to someone else who is a professional at this, who does this every day. And on top of that, they're going to give you a checklist of things that they want to see. So you can get a little bit of a free review and get some feedback from professionals. So talking about external fraud. So external fraud is when somebody outside your company is trying to steal money from you. This is going to take one of two forms generally: spear phishing attacks against high value targets inside your company. So what this looks like is your CEO's email gets hacked. an email is sent to your CFO suggesting that they should send some money to a vendor. Okay. CFO sends a wire transfer, that money's now gone. This is so ridiculously common. It just happens all the time. So your way around it is proper communication protocols in place from day zero. You need to understand when you're moving money, when you're making major decisions, have an agreed upon pattern of how it's going to be communicated. And then on top of that, you want to have a slightly paranoid, risk-aware culture where asking questions is the norm. The companies that really get lit up with this stuff tend to have a very top-down authoritarian culture where the CEO says, do this, and it must be done that day, and you better not ask questions. That is not what you want when the CEO's email gets breached. And then the other aspect of this is the external fraud where your customers' accounts will get breached and their money can be stolen through whatever mechanisms. In that case, the loss to you is generally because they are your customers, you're going to end up eating that loss, or you're going to end up with some very bad publicity. And you may take a hard line and say, no, we're absolutely going to the customer's responsible. They took the loss. As soon as you start to get the really bad publicity, you might have a change of tune, and you're then going to be on the hook for potentially significant losses. So in both cases, you want to provide all the tools your customers and staff need, from two-factor authentication, account takeover detection running behind the scenes, that kind of stuff, and do that from day zero. Last one I'll talk about is insider fraud. So when you say insider fraud, everybody gets this vision of, like the corporate spy kind of, getting a job in order to compromise a financial institution. And that does actually happen. There are cases where that has happened. And they can be wildly sophisticated, but usually insider fraud is just a sad story. What happens is you end up with a mid-level staffer with a lot of leverage. They've been around for a while, so they understand how things work. They often get addicted to gambling. That's like the overwhelming majority of the problem. They start losing money. They start stealing to cover losses. And the loss, they can cover it because they know how to shuffle the money around to make the losses not apparent. Maybe they'll steal from customer accounts who don't log in very often, that kind of thing. And then eventually the losses get too big and they get found out and it all blows up. And companies have been absolutely sunk by this. So the key things, you need proper background checks on all staff from day zero. And they need to, you need to have increased scrutiny with increased leverage roles. And you need to redo them periodically. So your background check should be happening once a year for highly leveraged staff, and you should know if something's gone wrong and your payments folks' credit rating is crashing. You maybe need to have a difficult conversation. Sophisticated fintech investors are going to expect to see this, particularly after we've had some crypto blowups where founders left the building with the money. They're going to want to see this. Again, proper processes on money movement and segregation and separation of responsibilities as soon as you can. The reality is, for a startup company, you don't have enough people to be segregating responsibilities like a bank would or like a large fintech would. But as soon as it's possible, you need to reevaluate the idea that you have one person signing off on transactions, one person signing off on KYC, whatever may be, right? And so just wrapping it up here, so some key takeaways. Building a risk-aware culture is absolutely the cheapest protection you're going to get, and it's some of the best protection you're going to get. If all of your line staff understand that you work in, you work for a bank or you work for a finance company, and they can ask questions. If they see something weird, they need to investigate it. That's just the best protection you're going to get. Dormant accounts need to be purged. So there's this thing in startups, right? Everybody likes to say we have 50,000 accounts, even if like 5,000 of them logged in the last 3 months. As a fintech, you don't get to play with that. You need to lock those dormant accounts, or at least force them to go through any KYC up to your most current standard should they attempt to relog in. everybody wants to move fast and break shit, and you absolutely do need to move fast and break shit, but you're going to need to implement process sooner than other startups. The risk factors are different for this versus a social media app. What we do is just, it's the deep end of the pool, and you need to understand that you're going to have some processes in place. Trust but verify, particularly if you're working with partners. Just because somebody says something is true doesn't mean you should necessarily believe it. And for some reason, technical founders tend to be really, really trusting on other people's claims about what assets they may have backing or what government guarantees may be in place. Verify it, and don't hesitate to do an audit. And when you go to partner with a significant player, do not be insulted if they want to do a deep dive into you, your finances, your tech stack. They want to really understand who you are before they're going to really connect with you. And then finally, run a red team exercise regularly. So red team exercises are when you all sit around a table. It's a great Friday afternoon activity with a couple of beers and pizza, and figure out how you can steal money from your own company. And sit down with some smart people who know your stuff, and occasionally invite in outsiders, and just try and get some ideas on how this could be hacked, how people could rip us off. And you might find something that is alarming to you, and fix it ahead of time. So that's it. I'll open it up for questions, or if anybody wants to reach out direct, it's me at johnschaub.ca.
Thanks, John. I really like that idea for a Friday afternoon activity. Sounds like a lot of fun. I think I'm going to invite the audience to whoever's left, because we have lost a few folks, but whoever's left, please use the Q&A section. But I'm going to kind of break the ice with the first question. It's about disclosure. And you touched on a few kind of topics related to that. And maybe there's part A, part B is when something goes wrong. And when there's some suspicious activity or there's something, and how do you approach those big guys, the financial institution? I know there's some transaction, I need to talk to TD. Who do you even talk to, or what is there a certain good way to do it?
It's a fantastic question. So the key with any of this stuff is to build those relationships before you need them. You do not want to be calling the VP of risk at, pick a big bank on a Friday afternoon and trying to introduce yourself and explain why you need information on customer accounts. It's not going to be a fun conversation. Those people tend to be extremely paranoid by nature, so don't expect that they're going to just answer your questions off the bat. But what I always try to do is build those relationships ahead of time, meet them at conferences, meet them at those networking events. Vendors can be a great way to get intros to folks, because you all tend to use the same sort of cybersecurity and fraud prevention solutions. So, get those intros ahead of time. Connect on LinkedIn, maybe, buy them a coffee when you're probably going to have to be out in Toronto to do that. And that way you've got the relationship in your back pocket when you need it. And when you need to make that phone call, you know who to reach out to, you know who to talk to, and you're not coming at them cold.
Okay. Makes sense. And I guess the part B of the disclosure was, when something truly is wrong, I know, for example, when there's a breach in private client user data, there's no question in my mind. You have to be transparent. In fact, in certain jurisdictions, there's rules about this. But what about like a couple customers' account being drained through some fraud? Like, do I have to be public about this as an early stage startup?
Not necessarily. So first of all, private information disclosure, you're absolutely correct. I didn't cover off on that, but that's something that often you will have. Attackers will just come at you just for the financial data, even if they can't necessarily move money, because they may want to answer security questions on some other site, or they may be wanting to build a dossier on someone on a high value target. So that personal information can be a very attractive target for attackers. Yes, there are laws and regulations. I am not a lawyer. This is one of those places where you should definitely call in a professional on what exactly you have to disclose. Generally speaking, though, on the compromised account, someone lost a bunch of money. It's a customer service issue, provided you can refund them the funds. As long as the customer ends up good and you're protected and they're happy at the end of the day, you don't have to go and disclose. Accounts are compromised on a minute by minute basis in Canada when you get into all the FIs added together. So there's no notion of disclosure.
Right.
But when you have a big breach, yeah, there might be reasons you have to disclose, and understand you're going to take a massive brand hit when people first hear about your product because a bunch of people lost money. That's just really hard to recover from.
Yeah. Yeah. And usually you don't have budget for a good professional PR. Um,
Exactly.
I might have to cut the questions short. I hope you don't mind, John. We're definitely recording this, so we might have to repackage this. But if anybody in the audience has a burning question, please use the Q&A now. Otherwise, we'll find a way to share John's talk, because I'd like to get on to announcing the jury selection